our thinking is having a business like this will help us in a capex light and scalable way partner with some of these newer entrants versus trying to compete and continuously have to deploy tremendous amounts of capital. Also, again, we really like we said, the fact that it comes with that energy hedging team. There's a ton of greenfield and brownfield opportunity, which also, as we talked about some of the opportunities in AI, there's a lot of capacity and different ways that we can grow as a combined company.
Welcome to this new episode of Bitcoin Equities Talks. Today with Sue from Hot 8. Perhaps you can present yourself and what Hot 8 does in the Bitcoin mining space.
Absolutely. So really excited to be here today talking to your audience. So my name is Sue. I'm head of IR here at Hut 8. And Hut 8, we're one of the oldest Bitcoin miners in the industry. We've been around since late 2017. We're also one of the first miners that started hanging on to Bitcoin on our balance sheet. So we've got a little over 9,000 Bitcoin on our balance sheet. We're also in the middle of a very transformative merger with a privately traded Bitcoin and energy infrastructure company south of the border in the US. So lots to get into today, and it's a really interesting time to be looking at Hut 8.
So what makes Hut 8 different from other Bitcoin miners, whether it's about sourcing the energy or about the strategy and acquiring the electricity or the mining machines? What's your unique selling point?
Yeah, so I think what's very unique about Hut 8, as I mentioned, is our particular commitment to hanging on to our Bitcoin. And one of the reasons why we have been employing that strategy almost from the beginning of our operations has been because it's enabled us to have a lot of flexibility and capture opportunity using this Bitcoin as collateral. So for example, in the 2021 bull market, we had a portion of our Bitcoin that was actually earning yield. And then also in the most recent bear market and also in the bear market of 2019, we actually were able to take out loans against that stack of Bitcoin, which helped us keep the lights on, helps us stay flexible and lean. So that's certainly one piece of our business that's quite unique. Another piece of our business is that in January of 2022, we actually started buying traditional data center assets. So cloud, co-location, data centers. And there's a few different reasons behind our thinking on that. So number one, we liked that it was a completely uncorrelated relative to the Bitcoin mining space, which can obviously have, quite a bit of volatility. Number two, it also came with over 300 customers in the existing cloud and colo space. So these were customers in the special effects, the financial services, the government space. And number three, it also establishes us in a really interesting niche in the high performance computing space here in Canada. And ultimately, at the end of the day, we see a world where Bitcoin data centers, traditional high performance computing data centers, and now AI are all living under the same swath of composable infrastructure and composable compute. So we really look at ourselves as effectively operators that are maximizing value at the intersection of compute, energy, and infrastructure.
Okay, wow, that's a big development actually from last time we talked. I think it was 2 years ago. So congrats on that. You're not the first miner mentioning that to me. Can you explain to me perhaps a little bit further how AI and Bitcoin mining are similar in terms of data center? How would you compete with the Google and Amazon of the world when it comes to servicing these HPC and AI data centers?
Yeah. So one of the things that's unique about AI chips in particular is that they're not as latency sensitive. They don't have the same requirements that are traditionally needed in a data center that's housing other iterations of compute. And so they don't have 5.9 reliability. They're not as latency sensitive. And so if you are an infrastructure operator who has access to, cheap or reasonable power, you understand how to stand up infrastructure at a decent price point, because again, the AI infrastructure isn't as expensive to stand up as is a traditional data center that's anywhere from $7 to $10 million per megawatt. So if you understand the infrastructure, you have access to good power contracts and a good power portfolio. You have relationships across the chip supply chain, because obviously AI chips are very high in demand. And you obviously have the greenfield space there's a real opportunity to stand up sort of these hybrid data centers that aren't quite the traditional cloud and colo, but also are not Bitcoin mines, because Bitcoin ASIC chips are a lot more rugged. They can withstand more extreme conditions versus AI chips are highly sensitive, very expensive, and you want to make sure you don't even get like a speck of dust in them, because that could potentially blow them up or destroy the chip. So there's a real opportunity for operators that have the expertise I just spoke about to now start playing in this growing market and demand for AI infrastructure.
Okay, that's interesting. I didn't see it that way. So what you're saying is that there is a specific niche market for data centers operating AI and HPC that is completely different from the traditional data centers, like imagine all the YouTube videos and all the Amazon servers, etc., have a different setup and a different way of functioning.
Correct. Yeah.
Okay. Perhaps you can tell me a little bit more about your recent acquisition, at least what's public of it.
Yeah, so it's not an acquisition, it's a merger of equals. And we're still in the process of going through the approvals process with the SEC. We did just have our shareholder vote on September 12th, and our shareholders voted overwhelmingly in favor of the transaction going through, which is really exciting. So the company is called US Bitcoin Corp, and they're a privately traded Bitcoin miner and energy infrastructure operator out of the US. So they have locations primarily in Nebraska and Texas and New York. And some of the things that we really liked about this from a growth perspective and the future of Hut 8 is getting into diversified power markets, their infrastructure operator expertise. So these guys actually were able to stand up 1 exahash of infrastructure within 43 days. So they are very, very savvy infrastructure operators. They have an energy hedging team. And they also have this really interesting business called managed infrastructure operations. And so the total power that they manage right now, and from a Bitcoin mining perspective, is a little over 720 megawatts. But about 680 megawatts of this business is managed by a program called Managed Infrastructure Operations. And what it is it's effectively like a white glove mining services and software platform. And so they have clients who want to mine Bitcoin come in, and it's sort of like the WeWork model. They manage everything. They run the machines, they repair the machines. They have a software that helps with energy curtailment and electron arbitrage and machine efficiency. And so we thought that business was super interesting, because one of the trends that we're seeing, first of all, no other competitor in our industry has publicly disclosed that they have a business like this. They actually run in this business some of our competitors' hash rate. So a lot of our competitors who are asset light, they actually use US Bitcoin Corp's managed infrastructure operations under that umbrella. So one of the things that we thought was really interesting about this business is how CapEx light and scalable this business is. So if you look at what's changing in the mining industry, is you're now seeing entrants from the oil and gas space, from the Middle East, who's standing up a ton of renewable infrastructure, looking at using Bitcoin mining as either a tool for mitigating methane or as a tool for balancing load on renewable grids. And so our thinking is, this business is highly scalable, it's highly CapEx light, and with the halving coming around the corner, at Hut 8, we think that single-threaded miners are going to be at a lot of risk, because mining is an incredibly capital-intensive business. You're going to have your rewards cut in half in May of 2024. It's the natural deflationary cut in supply is going to kick in. So it's going to go from, I think, a little over six coin rewards down to 3.125. And so our thinking is having a business like this will help us in a CapEx light and scalable way partner with some of these newer entrants versus trying to compete and continuously have to deploy tremendous amounts of capital. Also, again, we really like we said, the fact that it comes with that energy hedging team. There's a ton of greenfield and brownfield opportunity, which also, as we talked about some of the opportunities in AI, there's a lot of capacity and different ways that we can grow as a combined company.
Okay, and so after the merger, you will remain listed or you will become a private company?
Oh no, we're going to remain listed. We'll be trading on the TSX and on the NASDAQ.
Okay, I see. It's very interesting actually because I'm seeing a shift, and this is like the first illustration of it. Like for the past 3 years, I would say most publicly listed miners were self-mining instead of hosting, and their evaluation basically was based on their mining exahash power, basically.
Mhm. Mhm.
And this puts them at risk of the volatility of the Bitcoin price, which makes it tough to manage costs and expenses and the electricity prices. But also at the same time, with the difficulty increase and the halving, there are so many moving parts. So I
Mhm.
was expecting, like at one stage, the market to calm down and to come towards people that are doing a mix of both, like servicing clients and self mining, because of course you have to capture the opportunities when they are there. So the self mining is interesting.
Mhm.
But when you couple it with a kind of service business where you have like a cash cow bringing in new clients because you have developed an expertise and
Mhm.
you want to show it out basically, and you want to monetize it. I was hoping to have this. The parallel I saw was with the oil and gas industry, where you have like the extraction and then the refinement, and it gives them like a kind of balanced
Mhm.
revenues. When one goes bad, the other does well, and vice
Mhm.
versa. Is it like something you think a direction where we'll see more and more Bitcoin miners going?
Well, that's tough to say because it's something that they've been building up for quite some time, and I'm not sure that a lot of our competitors are thinking sort of directionally like that. So I would say it's a pretty unique offering for Hut. I'd say it's pretty unique.
Okay. Last month I was talking with Fred Thiel from Marathon, and he's using these types of operation. I don't know if it's
Oh yes,
disclosed basically, but
yes.
this
So
is their setup where they're deploying capital through companies that are hosting their materials and their mining power and managing the operations basically.
so US Bitcoin Corp does manage a portion of Marathon's hash rate.
Okay, I got it. So this makes all sense then.
Yeah.
Okay, and you mentioned the halving. Some of the miners and Bitcoiners in general see it as a catalyst for Bitcoin, like so there will be less supply from the miners selling Bitcoin to hedge their operations. And some of them see the Bitcoin ETF also coming at the same time. So kind of a lot of stuff coinciding in the next months at least. How do you see the halving from a Bitcoin miner's perspective? Are you afraid of it, or are you looking forward for it to get rid of the competition or the less competitive miners? How do you see it?
So we're certainly not afraid of it because we've been building up our business with a plethora of diversified fiat based revenue that we think will be a major competitive advantage going past the next halving. That's another reason why we've also been hanging on to a large part of our Bitcoin. So, as I mentioned earlier, we have a little over 9,000 Bitcoin on our stack. And if you look at past halving Bitcoin cycles, usually within about 12 or so months after a halving, we see an extraordinary price increase in the price of Bitcoin. And if a spot Bitcoin ETF is approved in the US, we do see that as a potential catalyst event for not only greater Bitcoin price adoption, but obviously more demand for the spot actual Bitcoin, which will create an upward pressure on or upward momentum on prices. What's different about this halving versus past halvings is the amount of more research on ramps and adoption from the institutional space into Bitcoin now versus where we were in the last halving, which was 2020.
Okay, so self mining in the future after the merge, hosting. What could be HPC, AI? What other sources of revenues do you see? I struggle to find Bitcoin miners or listed Bitcoin companies building more on Bitcoin, like going into payments perhaps, or going into other layers on top of just the mining space.
So
And
that's
again, I give the parallel with oil, where you have like the refinement, but then once you go into the oil refinement, then you get so many products, and all these oil producers have become expert in all the sub products of oil.
Yeah. So, and that's a really interesting point. So, this is another reason, this is another area where our HODL, our held Bitcoin stack, comes into play. Is there a world potentially where, post having Hut 8 maybe becomes one of the largest Lightning node operators? That's within the realm of possibility when you have a tremendous stack on your balance sheet, right? So that would certainly be a BTC layer 2 application that we could participate in. And as I mentioned before, in past markets in 2021, we had some of our coin that was earning yield. And so being able to thoughtfully put that stack to work is something that we've done in the past and something that we could certainly potentially do in the future, like, for example, in a Lightning node application, which also would obviously be very pro Bitcoin support and network adoption.
Yeah, just for our audience who's not aware of it, so Bitcoin Lightning Node is a setup where is a technical solution that sits on top of the layer one of Bitcoin, which is the Lightning Network, and it allows people to transact through a layer two solution, which has much less cost than the layer one. And
Yeah,
actually, the Lightning wallets that are developing today are just amazing. I stopped orange pilling my clients and my friends by long speeches and demonstrations about Bitcoin, but just by sending them Bitcoin through Lightning. It's so efficient and it costs nothing that they're like blown away straight away.
yeah, it's like the PayPal for Bitcoin, but with Bitcoin's security layer. So it's really interesting. We're certainly seeing the adoption curve going upwards for the Lightning Network, and so again, we're setting ourselves up as a business so that we can participate in as much upside as possible post halving.
Okay. Coming back to some economics, if an investor today wants to value a Bitcoin miner, how would you recommend him to look at it?
So again, I would certainly look at, what is their strategy post halving? Because Bitcoin mining is a very capital intensive business. So you're always at the mercy of new, more efficient equipment coming down the pipeline. Potentially, where is energy trading at? So I would look at, what are they doing to make sure that they stay alive and nimble post the next halving? I'd also want to look at, again, how diversified is their business? Are they super reliant on massive capital injections? Are they earning fiat steady eddy income? I would look at power portfolios. So, how expensive is their energy? Because that's obviously the number two input to a Bitcoin miner's business beyond infrastructure. And look, Hut 8, we certainly think HODL, as I've mentioned multiple times, is a major competitive advantage because if you even were trying to catch up to Hut 8's 9,000 stack starting from zero, from a cost perspective and even how the network is designed, it's almost impossible to catch up to our stack in the next 7 months or 8 months before the next halving. So those are some of the things I would look at. How diversified are they? What do their power portfolios look like? And what is their post halving strategy?
Okay, that's interesting because when you talk about power, and I want to come back on this point, some Bitcoin miners disclose their power prices. Some used to disclose them and stop. Some don't disclose them at all. And some have sometimes negative electricity prices because they are getting paid in Texas, for example, for curtailing, and then
Mhm.
they're making more revenue just turning off their Bitcoin mining machines instead of putting them on and getting paid from the electricity operator. So, if I hear what you're saying, we should go towards the one that has the curtailment rewards in place.
So not necessarily, because those operators, and again, I'm not, every single one of our peers and competitors has done a great job at, standing up a lot of infrastructure, and I think they run great businesses. But those operators are still at the mercy of headwinds that are coming with the halving. So your rewards are being cut in half. You have major entrants like oil and gas, the Middle East, that are now coming, that's going to push hash rate up. And so they will still need to continue capital investments into competing in that space. It's a very expensive business, even if you are sometimes lucky and there's a very hot July in Texas and you make 5-10 million bucks on demand response programs. You still have a business that is not nimble and it's constantly requiring major capital infusions to stay competitive. So this is where we think diversification is a really, really compelling idea, because at least with Hut 8 strategy, it's capex light, it's scalable. You also have the HPC business, which is completely uncorrelated revenue. I mean, the CAGRs and upside there, I think, are almost about 10% over the next 5 to 10 years. So those are the things, as an investor, I would ask myself, well, how are these guys going to keep the lights on when it gets more expensive and the rewards are cut in half, right? So,
Okay. And what about holding a Bitcoin miner's share or holding Bitcoin itself? I get this question quite often when it comes to our Bitcoin equities ETF. So, how would you see one versus the other? Should investors hold preferably Bitcoin, then Bitcoin miners, or preferable Bitcoin miners, then Bitcoin, or both?
yeah,
And in your case, it's a bit tricky because you're already holding Bitcoin. So just holding you intrinsically means holding Bitcoin, or at least
exactly.
part of it.
Exactly. So we look at ourselves as a call option on the price of Bitcoin because we hold such a tremendous stack, but then also a call option on the growth of like some of the business lines we've talked about, high performance computing, are managed in a post merger world, hypothetically speaking, if we get that through, managed infrastructure operations. So that's a really meaningful platform and services business that we believe is going to scale as more entrants come in. And so you're not just getting a call up, you're not just getting exposure to Bitcoin, you're getting exposure to upside in high performance computing, Bitcoin, the growth of the Bitcoin ecosystem, and additional services layers. And so we think that that's like pretty meaningful because you don't get that additional upside just by holding a Bitcoin in a custody account.
So in the scenario that Bitcoin goes to zero, what you're meaning is that you remain with a business that could not go to zero, basically, because you have other sources of revenue, right?
Okay, well, I certainly am not allowed to make any forecasts about the value of our business, but hypothetically speaking, we have a diversified business structure so that, yeah, there's different levers that could create upside and protect on the downside relative to another.
Yeah. And when I look at the history of the Bitcoin miners, I see them performing like having a beta that is quite high. We have a lot of Bitcoin miners in our ETF, and their beta is really above 100% to Bitcoin. Do you see this beta staying high or getting higher or getting lower in the future?
Yeah, that's a really good question. I think it still really remains to be seen. You know what? I don't have a good answer for you on that. I think there's so many variables at play here. Like, so for example, at the end of August and beginning of September, we saw some relatively unprecedented dynamics take place in the sense that we had a declining price of Bitcoin, but hash rate was continuing to grow and climb. And part of that is because, as I mentioned earlier, you have some of these newer entrants, for example, out of the Middle East, that are now getting into the mining space. You have renewable energy infrastructure operators now getting into mining, oil and gas. And so we're seeing a lot of new and unprecedented dynamics coming in. And so I don't particularly have an outlook or want to give an outlook as to where I think beta is going to stay. But I think that, again, the operators that have diversified, stable, steady businesses and are able to pivot and capture opportunities in different areas are going to thrive and survive past the next halving.
Okay, and what about hedging? Do you use any hedging? Because in the gold industry, for example, they have gold royalties models that where they share part of the risk of mining with external investors. Do you see this in the Bitcoin space, or do you see Bitcoin miners doing it?
There are some miners that have deployed derivative strategies on some of their smaller stacks. Hedging is certainly something that, we've looked at. And then again, I think in a post-merger world, we'll have more clarity for you, or we'll have more better sort of roadmap as to where we're at on that side with respect to our stack. From an energy perspective, the US Bitcoin Corp does have an energy hedging team, which is another thing that we really liked about this deal. And so, yeah, certainly again, mitigating and finding strategies to mitigate for some of the volatility that comes with this industry is very important.
Okay. Going back to the merger, there was 4 or 5 years ago, there were like a lot of concentration in Bitcoin miners. And as time passed by, this concentration kind of evaded. There's like, last time I looked, I think all the listed Bitcoin miners represent less than 25% of the of the Bitcoin. So 75% is like private still.
Yeah.
And but in your case, you're merging. So how do you see this industry going forward in the future? Bigger miners or more and more smaller miners? The trend has been quite weird, because I was expecting like more concentration, economies of scale, development of expertise, of know-how, etc. But maybe it's in the bear market that we see these mergers happening and concentrations happening. In the bull market, everybody's making money, so a lot of people launch Bitcoin mining operations. How would you see it on your end?
Yeah. So in the last bull market of 2021, we saw something like 19 new entrants come to market. So it was certainly, operators who saw incredible margins. And, we've seen a few of them die out in the past bear market, just because, again, people taking on far too much debt and thinking that sort of the good times were going to continue, and they obviously didn't. Moving forward, though, again, we do think that we're going to see some consolidation coming up to the next halving, because the rewards being cut in half is a real substantial change into the incentive structure, right? And that's part of the beauty of Bitcoin. So I think we're going to see some consolidation. And then, yeah, I think we're going to see some major private players beef up and build up in the industry. As I said, in the renewable space, in the oil and gas space, in the Middle East, there's 6 gigawatts worth of renewable infrastructure that's being stood up in the Middle East. And as we've talked about, miners are a complement to renewable grid operators because they help balance load. And so when you have an operator out of the Middle East where they effectively have 0 cent power, or like 1 cent power, and unlimited pockets, I do think that that's going to potentially wipe out some of the smaller players.
Okay, interesting. So concentration, competition, and a lot of things to come in the future. Thanks a lot for being on this call. I'm going to share all the details that you have publicly announced on your website to the audience. And I hope we'll be able to jump again on the call once the merger have been completed and the new roadmap has been announced.
Absolutely. It was a pleasure being on. Big fan of your show, and we'll talk soon.